In the US, tax cuts and government spending have delivered buoyant consumer confidence, corporate profits and jobs growth, and this has led to a progressive rise in US interest rates. In September, the Fed lifted interest rates for the third time this year by a further 25 basis points to 2.25%. While this has so far been positive for US shares, it hasn't been good news for everyone. Emerging markets such as Turkey, Argentina and Indonesia have suffered from increased borrowing costs and falling currencies. Locally, two themes dominating headlines have been a falling Australian dollar and a slowing property market. The Aussie dollar reached a two-year low of 71 cents in September. A weaker dollar tends to have a positive impact on economic growth and inflation, and our second quarter GDP data showed that domestic growth has reached its highest level since 2014. House prices nationally are down around 2.7% from the peak in 2017. While not a large decline, difficulty in obtaining credit from banks has resulted in lower activity, which in turn puts further pressure on prices. That said, so long as the economy remains strong and unemployment low, the prospect of an outright crash in housing seems pretty remote. US-China trade tensions have been escalating. On the 24th of September, tariffs imposed by the Trump administration on an additional $200 billion worth of Chinese trade came into effect. In a tit-for-tat move, the Chinese authorities announced additional tariffs on $60 billion of American products. So should you be worried? Well, an ongoing dispute between the world's two largest economies has the potential to slow global growth. We do expect that there will eventually be a negotiated outcome, though this may take some time. Markets don't like uncertainty, so the trade war remains a key point to watch. In the meantime, though, the implications for Chinese exporters has not escaped share markets, and the Chinese share index is now down around 23% from recent highs. While markets remain strong today, economic conditions are not as rosy as they were last year, and ongoing political tensions will bring greater uncertainty. While we think it unlikely that shares will continue to deliver the strong returns of recent years, a well-diversified portfolio should still deliver solid outcomes over the long term. Your financial planner can help you construct a portfolio that's aligned to your long-term goals.